Hi, this is James Zhang, and today we're going to be talking about the dip. The dip for, let's say, medical students is organic chemistry. Your sophomore year of college. The dip is anything that is difficult, right? Anything that is going to create scarcity, and scarcity is going to create value. And Seth Godin wrote a great book about it. And today I'm going to be talking about overcoming the dip as a multifamily investor, and then more specifically as a general partner, and the three dips you have to overcome. So let's talk about sort of from general high level multifamily investors. So an individual, right? So they might have sold their business. They might be a high income professional like a doctor, lawyer, accountant, and now they want to invest in multifamily. So what is their dip, right? They already have the money. They already can qualify for the loan. Their dip is really finding new deals, right? How is that listing broker going to hand this person who's a brand new person a new deal, right? And so how do you get around that? As a general partner, we're going to talk about three dips that they have to overcome. And then as a limited partner, your job as a limited partner is really learn enough to underwrite deals and then find general partners to invest with. That is your dip. And people overcome that in a lot of different ways. Some people join groups, some people go to conferences, some people just network, listen to podcasts, all different ways of going through that dip. But on this particular webinar, when we talk about general partners and their dips around finding new deals and limited partners. And so the first one is really going from 0 to 1, right? So the debt part of 0 to 1 is you're really going to be looking at recourse bank debt, Freddie SBL, potentially Fannie Mae. Your team is really going to consist of listing brokers, mortgage brokers, property managers, attorneys, insurance brokers, because it's really just going to be you and maybe a couple co-sponsors on that first deal. It's going to be your own equity, right? You might raise some money, 1 to 3 million maybe, from other investors, probably sophisticated credit investors, 50,000 a piece at a time. And you're going to qualify on your own. You're going to sign on the loan. You might have a few other key principals sign with you, and your target deal is really going to be, BC deal, under 100 units, purchase price of about $10 million and under. So your job is really building the team, find deals, qualify for that, raise equity, and probably you're targeting one market. And so your challenge is qualifying for the loan. Let's start there. So you need somebody to sign with you for multifamily experience. You don't have it, and you probably need somebody with a balance sheet to help you. Second challenge is raising enough equity or saving enough for the down payment. So third challenge is having listing brokers take you seriously, right? Because you haven't done this before. And the fourth is, you really want to buy yourself another job, right? So if you go out and buy a 10 unit or 20 unit, that might be so small that you have to self-manage it because it just doesn't make sense to have third-party property management on site. So I wanted to go through a case study. Satya Messina was a former IT guy, and he really started probably about 5 years ago. And he started with smaller transactions, qualified with bank recourse loans, and then as the deals increased in size, went to Fannie and Freddie. He sort of built his track record over time with listing brokers by closing deals, and then used his own equity at first, and then 1031 exchanged into larger properties. And then as those grew into larger deals, 60 plus units started syndicating the equity. So here's some properties that he bought. You can tell, like, sort of going back 5 years ago, he started with sort of 37 units, then he bought 24 units, and then sort of 1031 exchanged that into 87 units, and then 1031 exchanged another property. And then this past year, he really bought some larger properties and syndicated that equity. And at that point, he quit his job, right? So the whole time he was, doing this sort of on the side. And then once he had 4 or 5 properties, had the track record, could go out, buy larger properties, then he quit his job and became full-time in real estate. So the next dip is really 1 to 20. So as people are, there's a lot of people, sort of 0 to 1, I would say probably only 10%, maybe 20% of the people will get there. And then this next dip is the next set of 80-20 principle. And your team now, as you go from, let's say, 1 property to 20 properties, is really, you need an asset manager, number 1. Number 2, you need investor relations, right? Because you are going to be building out your team. It's more of an internal team now, right? Because you can't just can't do it all yourself, right? With 20 properties, there's a lot going on. There's a lot of properties to manage, a lot of investors to work with, and so your team changes. Your debt's going to change a little bit. Fannie and Freddie are still there. You might start looking at non-recourse bridge, and now you're really starting to raise 5 to 10 million per property. You might still be going individual investors, sophisticated and accredited, and at this point, you really need to start looking for larger KPs. Because let's say you buy a $20-30 million deal and you need a $20 million loan, they don't really want 10 KPs on these deals. And so you really need somebody with, a 10 plus million net worth to sign with you. And you really start to look at probably 150 to 300 units in terms of your deal size, 20 to 30 million. And so on this scaling from 1 to 20, it's really about building that internal team, because you're going to have to start raising a large amounts of equity to buy these large properties. So challenges, qualifying for the loan, I really say it's balance sheet. You already have the experience from your previous deals, raising equity. So this is a big one, because let's say you raise $10 million in equity and, you're doing 100,000 a piece. That's 100 different investors. So managing that process of raising the equity and then also keeping up with them throughout. You need a team of asset managers throughout this. You need accountants, you need operations, the investor communications, right? So you're pushing out monthly, quarterly, K1s during tax seasons. And then the biggest challenge, I think, as you try to grow this part of the business from 1 to 20, is that you're competing against institutional guys. So institutional investors used to stay at sort of the class A stuff. But because those returns were getting so low, they started moving into the B space. So there's a little bit more competition from those people in the space. So my case study on this one is Ken and Wend. They started with smaller transactions, 100 units, $5 million, and, raised $1 million on their first deal. And they qualified for Fannie Mae by partnering with other sponsors with a track record already, and then slowly built their track record over time, buying 1-2 deals a year. And then they really started raising a lot more equity from individual investors. So they, had meetings, had parties, had different things to, as you start growing from that first deal, if that first deal does well, then people start telling other people and you start getting referrals from other people. And so that's probably one of the biggest things growing from that 1 to 20 is your investor base has to grow, and people have to come along with you. And so they started in the 100 to 150 unit range and grew to 300 plus unit deals now. So here's a snapshot. They've sold 5 or 6 properties just in the last couple of years. And so now they have 9 sort of larger properties, all pretty much close to average size is probably 200 to 250 units on average across their portfolio today. So now the last dip that you have to overcome is going from 20 to over 100, right? And so some of the changes as you grow in size is debt. You have your Fannie and Freddie, but now life insurance is in there because you're targeting nicer properties, bigger properties. The equity is going to change a little bit. So you're raising 10 million plus properties. So you can do it individual investors, but most likely you're going to probably go to private equity firms. You might even, be in the public markets, like with a REIT. Your team is going to change dramatically, I think, too. You're going to have, a president of your property management company. You're going to have a CFO, COO, acquisitions director, investor relations, and your balance sheet. You might have a few people who are signing, and then your company potentially could be signing. Your target deals are going to be A and B, 200 plus units, purchase price of 20 to 100 million. So really here, going from 20 to 100 properties, you have a full-time team and you're partnering with very large equity sources to buy, to scale, to get to 20,000 plus units. So this list just came out this week. It showed the top owners from all the way up from number 1 at 100,000 units owned, all the way down to number 50, which had about 23,000 units. And, number 41 was Night Vest. And we just interviewed him this past week on a webinar, and he co-founded it. We interviewed David Moore. He told the story of him starting in 2008 with a Class C property that he bought for $12,000. Not $12,000 a unit, just $12,000. And he started Class C's, friends and family money, and then moved to Class B over the next couple of years. And then just the last 2 or 3 years, he's been more in Class A. And, he has a full staff. He has chief investment officer, CEO, controller, VP of construction, full management company, asset managers, acquisition staff. He's got 3 offices in Dallas, Houston, Phoenix, and he's raising equity from private equity guys and, getting loans from life insurance companies and Freddie conventional. And so just sort of wrap up with this quote, successful people lean into the dip, right? So dips are where, the more effort that you're going to put in, you're going to see the reward on the upside. And they push harder and are rewarded by the marketplace as being the best in the world. And so I've seen this dip across multiple investors over and over again as I've been, multifamily loan originator the last 5 years. And then also as an investor, I've seen this. And so if you have any questions about financing your next deal, definitely reach out to me. If you like this video, please subscribe to the YouTube channel, like the video, join the email list, and set up some time to talk with me if you have any questions on your next deal. Thanks a lot.